So we have a great panel today of all LPs, including me. I'm an LP, but I'm a moderator. And we have Rafiq from New York City, Ryan from Pomona, Chris from Abbott, and Todd from Makita. And I thought we'd start by each person introducing themselves, giving you a little feel for their program, and more specifically, how many commitments do you make a year? How big are your commitments? And just some general parameters over what you look for in new funds. And then we're going to talk about some specific funds that they've committed to. Okay, Rafiq.
Hi, Rafiq Dikasha from New York City. I work in the private equity group. I've been at the city for roughly 3 years. So a little bit about New York City's private equity program, or New York City itself. It's about $160 billion of assets under management. Private equity is about 6% of that market value. If you want to think about the private equity program as exposure, we're about $16 billion, so a sizable amount in unfunded. We're comprised of 5 separate systems that collectively roll into the New York City systems. We pace at roughly about 2.2 to 2.8 billion annually, and that goes into roughly about 8 to 12 different managers. Average check size is about 250 million, small end about 100, higher end about 500. There is a separate program that is internal, full discretion for the city, which is an emergent manager program of about 450 million or so, where the check sizes there are obviously on a much smaller scale, about 10 to 40 million or so. The team is relatively small but growing. We're about 3 professionals, and I guess I'll speak about some of our deals there.
Thank you.
Ryan Levy, Pomona Capital. We manage about $8.5 billion, principally in a secondary strategy. We also manage a couple $1 billion within that 8.5 in separate account primary fund of funds, as well as small co-investment funds. So we're about 45 professionals across 4 offices, so global, London, New York City, Hong Kong. On the primary side, we deploy anywhere between $100 to $300 million in any given year. Average check size is about 25 million. It ranges from 5 million to 50 million, depending on the opportunity. I would say that we concentrate in the buyout category. A large concentration for us is energy and infrastructure. So we put about 500 million in energy and infrastructure in the last 5 years in a combination of secondary and primary, and well over $1 billion into buyout opportunities.
Chris Ragazzo from Abbott Capital. Abbott was founded in 1986, solely focused on private equity. That includes everything from early stage venture to the large end of the buyout market. We have about $7.5 billion under management. Our client base is all institutional, and for those clients, we build diversified portfolios, fund of funds across all segments. Again, private equity. We also build specialized portfolios. We also involved in secondaries. In terms of our commitment pace, it's about $700 or $800 million per year in primaries, and in terms of check size, we'll go as low as $3 million in the real estate venture fund, up to more than $100 million in a larger buyout special situations fund. In terms of geographic focus, mainly developed economies, U.S. and Europe, where we do have a global mandate. So we spend a lot of time traveling over to China, India, Latin America, and just looking for attractive managers wherever they may happen to be.
Good morning, Todd Silverman, Makita Investment Group. We're a full-service investment consulting firm advising institutional investors, mostly pension funds, on all aspects of their investment programs, with a specialized service offering in private markets. In aggregate, clients have about $700 billion of total assets, of which we have direct involvement in advising or managing on a discretionary basis about 12 million target private markets allocations. We do about 8 to 10 commitments per year in private equity on a discretionary basis, about $40 to $50 million per fund. On a non-discretionary basis, our client appetite can take that to well over 100 million. In general, we have 100 people across 4 offices in the US, 1 in London, cover the market quite broadly, but have a focus historically on middle market buyout with private equity portfolios.
Great. And we, even though I'm moderating, I'll just tell you what our program is too. We commit 7 to 10 funds a year, 20 to 50 million per fund, all North America, skewed towards mid-market and distressed operational turnaround. And we also have an active co-investment program. So now I've been on both the LP side and the GP side, and I've been to a few conferences in my day. So I know what you're really looking for is, how do I get to be the fund that they meet with? And how do I, even better, get to be the fund that they commit to when they have so many opportunities? So our panelists are each going to give you examples of 2 funds that rose to the top versus all other funds in terms of both getting a meeting and getting a commitment, and why. So,
Sure. So the first fund I'll mention is a fund that we've known very well. The fund is Vista Equity Partners. It's a fund that I think 3 top reasons why. One, we've committed across multiple funds with Vista, and I think 2 will probably continue to be a good relationship. It will continue to be a good relationship. I think first and foremost is the fact that it's a manager we knew well. The manager started with New York City as an emerging manager in our emerging manager program, which is a program to help smaller managers, upstarts. So we committed to their first institutional fund through our fund-to-fund structure, and eventually graduated the manager to a direct commitment. And that direct commitment speaks to the second point, which is scalable capital. So as I mentioned earlier, we write relatively large checks of about 100 to 500, 250 on average, roughly. As Vista grew and essentially matured from an emerging manager, they started to grow the platform and branch out into other businesses. So no surprises for us. We knew the manager well. We had a strong relationship, so we were able to grow with the manager and essentially sized up well with Vista themselves. And probably the third point, and also a very important point, is the fact that Vista had a very specific sector focus. They focused on the technology enterprise software space. We like that space, obviously, but I think most important about that space was the fact that it sort of played across multiple industries. So it allowed us to scale up, manager we knew well, and the ability for us to really play in a sector that we really wanted exposure to. The second manager is on the other side. It's a very large manager. This is Warburg Pincus. And it's an obvious name, but it was a manager that was not in the portfolio before I got there. But it became an obvious choice for us, mainly because of the fact that, one, this was a large manager, a manager that gave us the ability to write a very large check. But probably most important is the fact that Warburg operated across multiple strategies, which we thought was very important. So with writing a large check and having the ability to scale, as I mentioned, Warburg provided New York City the opportunity to sort of get exposure to growth, to healthcare, to energy, sectors where we normally would have went out and sort of write separate checks to different managers, but this was the ability to write one large check to one particular manager. And so far the relationship has been good. We'll look at different platforms, again, playing up to the scalability. And once again, I think a good relationship in New York City.
So 2 new managers, both of them were big, and both of them offered diversification to their existing portfolio. So if you're coming in and pitching them, you want to be big and different from everything else they have. Ryan?
Small and scalable.
So, okay, small and scalable.
I'm talking about 2 funds. They're quite different. One's in energy, and one is called a small cap buyout manager. The small cap buyout manager is Comvest Capital. Michael Falk started the firm in the 90s. He's had a great track record. I'd say they've had a stumble or two in one or two funds, but I would say that they are fairly conservative in their marks. And so you have to wrap your mind around where the portfolios ultimately come out. That's where our secondary expertise comes into play. So we went through and re-underwrote all of their remaining funds and got quite comfortable with the ultimate outcome. So they are raising Fund 5. It's a $700 million, roughly, small cap buyout fund. You know, the ironic thing in private equity is I think everyone agrees it's a people business and you're never rewarded for upgrading your people. So turnover is a bad thing. It's a bad thing. It's a good thing. And you have to wrap your mind around the new team and what team drove performance, so attribution. So Comvest 4 is essentially invested by the current team that's going to be investing Comvest 5. It's a different team than invested Comvest 1 through 3. So I think of it, instead of as Fund 5, I think of it as a Fund 2. And if you can get comfortable with that and get your investment committee comfortable with that, and you look at where Fund 4 is going to come out, that we think is going to be over a 3 times net return fund, and you look at who drove performance there, who sourced the deals, who managed the deals, you combine that with a significant GP equity check to the tune of probably 10% of the fund's ultimate capitalization, and some significant retention efforts they have put in place to keep the senior team that invested Fund 4 and will invest Fund 5, you wind up in a pretty good place. What Comvest focuses on is, I call it revenue healthy companies that have some type of trouble in the cost structure. They're part of a larger corporation, they've been overburdened with costs, and they have been a focus of management. They're a family-run enterprise that has, where the management team has taken it as far as they can from a professional standpoint, and they need some help in executing. So again, the top line is growing by 20, 30, 40% a year, but the company's basic operations have not kept up. So Comvest can bring in some of their operating partners, look at the cost structure, look at the back office, and help rationalize that, everything below the revenue line. And we think that they've done a really good job of it. To a certain degree, they're a little bit of a CD&R model. I'd say they have less reliance on an operating partner model. They do have operating executives. But the other differentiator for us is we don't see a lot of funds in the $700 million space that we think operates in this area. They're located in the Southeast. They have a debt business which provides complementary deal flow. They have really good relationships with retired executives in Southeast Florida. And we think that they have delivered pretty exceptional performance, especially relative to the risk that they're taking. We look at their average leverage is under 3 times. So all in all, we found Comvest 5 to be a pretty good opportunity, and we committed to that fund, which the close will happen in probably about 2 weeks. The second opportunity, I'd say we're still going through the gyrations of underwriting, but it's with Kayne Anderson. Pomona's been a Kayne Anderson investor on the energy side for probably about 6 or 7 years, both through secondary investments in Kayne Anderson Energy Funds 3 and 4, and through primary commitments to Funds 5 and 6. So Danny Weingast is now raising an income fund where they're going to raise about $1 billion. They'll probably buy 5 large natural gas properties with 5 different management teams, so it's a bit of a resource fund play. They'll hedge about 70% of their gas exposure, let the rest free float. I think that the net return on this fund, they're targeting about 12 to 14%, depending on how they structure the hedge protection, if they sell calls, will beat median private equity. And there will also be an 8% current yield component. So for an insurance company, for a high net worth, for a family office, for a pension fund, for any number of investors, the opportunity to, in my mind, beat or at least meet median private equity returns with a cash component that de-levers your risk in that fund is a pretty significant opportunity. So again, we're still going through the gyrations of underwriting that, but I'd say those 2 are my recent favorites.
So 2 funds I'm going to talk about each had closed earlier in 2014. They're both on the smaller end. Abbott does do larger funds as well. But the first one I want to talk about is called Blue Sea Capital. Again, they closed in 2014 at about $325 to $350 million. They're a small buyout fund. They're focused on healthcare, industrials, and aerospace and defense. This is a first-time fund, more of a spin-out. The spin-out was from Brockway Moran. Brockway Moran was a successful fund that got started in the late 90s. It ran into some trouble leading up to the financial crisis, so there was some performance issues. Then there were some internal team issues between the 2 named partners, Peter Brockway and Mike Moran. They decided they weren't going to go forward with raising another fund. The junior partners of the firm, 2 junior partners And then the third partner, Blue Sea, is an ex-CEO of a couple of their portfolio companies. Decided to spin out and form Blue Sea. Peter Brockway is actually going to support the new offering, which lends a little credibility. Track record has been extremely good for the deals that they're marketing. They're marketing 7 deals from Brockway, sort of near a 4x type return on those 7 deals, 5 of which were exited. So what we liked about this group was the focused strategy. The team, sort of young and hungry, hadn't taken advantage of a lot of the carry that the older Brockway Moran funds had generated in the late 90s and early 2000s. And then the track record obviously showed some strong outperformance. So the main issue with any spin-out or situation like this is verifying the attribution of the track record, not just that the team we're backing was involved in the good deals, but trying to get to the answer of whether or not they were also not involved in some of the poor performing deals that led to the poor performance at the prior fund. So we did a lot of diligence, a lot of reference calls, got comfortable with that attribution, and we made a commitment to the fund, which again closed at a fund closed earlier this year. The other group I wanted to mention is called Oak HC/FT Partners. It's probably the worst name in private equity. The H stands for Healthcare and Financial Technology Partners. So this is also basically a spin-out, more of a firm that's splitting into 2. So Abbott has a long history with Oak Investment Partners, which is an established venture capital firm. So we've been on the advisory board of this firm for quite some time. The healthcare and financial technology team, which is headed by a woman named Annie Lamont, and she has a team of a couple of people. That performance has been very strong over the last 15 years. The IT team has performed less strongly over the last couple of funds. So there was an internal issue with the performance of the 2 teams, which was relatively siloed. So we were worried about sort of team blow-up risk in terms of monitoring the existing investments. So we worked with Annie and her team to facilitate a splitting of the organization. We worked through the issues that you might think would come up with that sort of dynamic, where there's a highly successful team and a less successful team. And we were able to sort of create an opportunity for Abbott to take part as a lead anchor LP in a new franchise that's going to be separate from the old Oak management company. It's a relatively small fund, about $500 million. It's focused on growth equity deals in healthcare and financial technology. So what we really liked about this opportunity was the chance to back sort of a new franchise and get an anchor position in what we think is a really strong opportunity. Annie Lamont has a fantastic track record over 15 years that's comparable to sort of any individual track record we might see in private equity, sort of 3.5x type return over 15 years. So we're really excited about getting the chance to get in on the ground floor of a new opportunity.
Okay, Todd?
Yes, so the first fund that I'll talk about, which we think fits quite nicely with what we seek to do within private equity, within buyout in particular, is HIG's Middle Market Buyout Fund, which closed earlier this year. This is an offshoot of the core buyout strategy for HIG, so slightly larger companies, larger transaction size. But in a market environment where we see pricing starting to look potentially a little bit inflated, we've continued to seek opportunities with managers who can find inefficiencies in the markets in which they play, who can add value operationally, and purchase companies at multiples that allow for both organic value creation, but also multiple expansion potentially in a market environment where multiples feel pretty rich overall. This is a situation where there was some additional underwriting required to get comfortable with the idea that this is a fund 2 of a non-core strategy, but with a firm that has a 20-year track record of very strong performance in everything else they've done in private equity. You have strong team continuity, both oversight from the co-founders, but also the senior partners who will oversee the effort on a day-to-day basis. And you do have a very strong value orientation, which we like. Additionally, this was an oversubscribed fund. We think it was a good example of how we access those funds by building relationships early before fundraising processes start, a formal way, maintaining a dialogue which allows us to make decisions relatively quickly without having to compromise the depth of our process. Second fund I'll talk about is a little bit different than I think what we've heard about so far within the emerging market space. Patria is a Brazilian private equity fund. We certainly recognize the risks of private equity investing in emerging markets, some of the volatile performance that occurred in the mid to late 90s, early 2000s. But we feel like, again, given the pricing environment globally, or particularly in the US, that emerging markets pricing feels relatively attractive today, and that if you can identify local managers with good relationships, ability to source, and ability to execute transactions, that by being judicious and by choosing the right managers, choosing the right geographies, and not just broad geographies, but sometimes country-specific funds, that provides a nice relative risk-return opportunity going forward.
Great. So we have a wide range, and at least 3 of the 4 panelists are open to the smaller, newer funds, and New York City is, but through their Emerging Manager program. I do have more questions, but I just want to, since they highlighted certain funds, I want to give the audience the opportunity to ask any questions on those funds before we move on. A brave question.
Before I pass around with the Carlyle group, I'm just curious. You didn't mention any of the public private equity firms like Warburg and Vegas, biggest fund you guys mentioned. Is there something that there's a lack of appetite for some of the bigger players, or are you investing in those and those aren't the ones you pick? I'm curious kind of what the dynamic of that is.
We've invested with Blackstone, we've invested with Carlyle, we've invested with a number of the public managers. I just think that for the panel, we chose things are a little more off the beaten track, so to speak. I think if you enter private equity, broadly speaking, the first names you hear about are large publics. Doesn't mean I'll be less than appetite for them. There is different.
Yeah, I'd say from Abbott's standpoint, we will invest in large funds, multi-billion-dollar, $10 billion funds. I'd say at this point we probably do have a negative bias to the publicly traded private equity managers. Our general sense is there's a bit of a misalignment of interest between the public shareholders and the limited partners of the funds in terms of where you want fees to be coming from and what's going to drive the share price versus what's going to drive sort of outperformance at the private equity fund level. So we never say never, but I think we'd have a negative bias towards them. And the other point being that we feel our value add is sort of uncovering some of these under the radar type opportunities for our institutional investors, and some of them certainly have the capability to invest directly in Carlyle or Blackstone without Abbott's assistance.
I would agree with the slight bias for smaller funds. I would say for us it's less of bias against publicly traded management companies. We do think there are some potential conflicts of interest, but that generally those can be managed and that we can get comfortable with it. But we're looking at funds of all sizes. What we really look for is differentiation and the ability to add something unique to our portfolios. And though I think what the larger groups do is very good and is a useful part of a broadly diversified portfolio, we also struggle sometimes to see the differentiation and the additional value that, as Chris pointed out, that we can add through the manager selection process.
I also think they fit in different parts of the portfolio. It's hard to justify investing in a $15 billion fund. In most cases, thinking you're going to get a 40% net IRR, 3 times multiple. It doesn't happen very often. Tom Betts did that in their 4th fund. They could probably repeat that. And then someone on the earlier panel mentioned, significant GP commitment to go along with that performance. Blackstone or Carlyle or Apollo probably makes it at the company level, but there's other things going on that change an individual writing a $60 or $70 million check. So we certainly invest in the large buyout funds. I just think they occupy a different portion of your portfolio than a $700 million fund that you think delivers that performance of a different sort.
Yeah, we're investors in some of the larger names, not as across probably more specific areas. But I think one of our focus now is really on some of the affiliated funds. So, for instance, some of the better strategies for some of the larger names on an energy fund or a European fund or an Asia fund will more than likely to focus on that fund rather than I guess a larger general buyout fund. And I can't necessarily say that there's any issue with the public component.
Okay, any other questions? The next question I wanted you guys to cover was your thoughts on allocations by geography and whether that's changed recently or it's been fairly stable over the last few years despite the ups and downs of all the different markets at different times or simultaneously. And how do you go about saying what % you're going to have in each geographic region, or don't you?
So I'll be brief, but because we're a large public plan and there's unfortunately a lot of restrictions as to geographies, emerging market restrictions, country restrictions, and so forth. So we're primarily focused on North America with an exposure, an annual plan for exposure to Asia, to Western Europe, and potentially branching out to potentially some Latin America regions. So hence the reason why we're looking at some of the larger names who we know well when there's some sort of affiliate fund with country-specific focus. It's difficult for us to travel, obviously, so it's tough for us to really get to know the regional, local managers, so we'll look to get that type of exposure through potentially a fund-to-funds program. So.
We're principally North America. We don't have geographic restrictions per se that the public plan does, but as we look at the opportunity set, Europe for select managers is interesting. We have, I'd say, about 20% exposure to Europe. Asia, emerging markets has been interesting but challenging. There's a lot of good unrealized marks there. At the end of the day, cash is cash, and we haven't seen a lot of the cash come back. So that being said, we're still looking at select managers, but the majority of our exposure is going to be in North America due to the opportunity set, especially when you start factoring in FX. If you invest at the wrong part of the FX cycle, you could have a great returning European fund. There'll be a mediocre net of FX return for the investor.
So Abbott has about 30% exposure to Europe, mainly European buyouts. We've been investing over in Europe since the mid-1990s, so we know the market well. We have an office over in London. In terms of where we're looking currently, we really have a bottoms-up approach, so we're not taking a long-term macro view about Europe might be out of favor or in favor. A couple of years ago, it looked like people were worried about the euro disintegrating. We were not sort of shying away from potentially committing to groups and existing managers in our portfolio based over there. We have spent a lot of time looking at the emerging markets, but again, we're benchmarking all of these opportunities against one another. We're not looking to fill a hole with Asia, with China or India or Latin America. So given the currency risks that Ryan mentioned and the other risks in terms of the depth of those markets, some of those markets, it's basically kept us out of the emerging markets mostly, given that we haven't seen sort of a risk-reward profile that we generally think would be compelling.
Our portfolio has historically been 2/3 to 3/4 North America focused, and generally, though, we try to be more bottom up than top down from a geographic, from a sector perspective. Having said that, and to the extent that our allocation by geography change, it does tend to be more incrementally. Not trying to be market timers for the most part, but having said that, we do see that Europe seems to be becoming more attractive again as that economy seems to regain its footing. Some anecdotal evidence of that is that we've seen recently now successful company restructurings in Europe, which we think was one of the early signs of capital markets recovery in the U.S. So I think that market, though we expect overall growth to remain relatively low in Europe, there are pockets of opportunity there. And as I mentioned before, we see pricing in emerging markets to be at a relatively attractive point, and we think that with the right managers, the risk-adjusted return there can be both attractive and a portfolio diversifier.
Great, and I only invest in North America currently, but in my career I have had global portfolio. And just from a personal note, I think European distress looks interesting right now. And I think a lot of the bigger GPs are viewing Asia as cheap and doing deals there, because relative to the rest of the world, I guess it is. But on the smaller end, you do have a problem with exits in Asia. So, but nonetheless, I think we're out of time. I don't know if we can take any more questions. So thank you.
Thank you.